Holy smokers, folks, this ain't no dang joke, because we have shocking stuff happening out here, folks. Tom Lee is now not bullish. Incredible move. Yes, you heard me right. Tom Lee is not bullish. We're going to react to this 2-minute clip here in this one, okay? Then I want to react to this one. BTIG says we're going to break October lows. Oh boy, okay? I'll react to that one, give my perspective on that one. And then this one, all the ingredients are here for a hard landing. Piper Sandler calling for a hard landing now at this point in time. And if all that wasn't shocking enough, okay? This might be the most shocking of all. Michael Burry says this crisis could resolve very quickly. I'm not seeing true danger here, okay? Now, by the way, it was actually posted on his Cassandra account, okay? Basically, he deletes all his tweets shortly after he posts them, and then you have to, like, post them other places, so that's why it's on this account here. But this was actually his tweet. And my gosh, do we have shocking stuff going on all over the place, folks. I mean, incredible. Michael Burry saying, it's not actually as big of a deal as some are making this out to be, right? And then you got Tom Lee here that we're about to get into. Oh, boy, okay, this market is it's a drama show now, folks. Hope you enjoy this video. As always, I appreciate everybody that joins me. As always, 24,600 plus subscribers. Oh man, I'm jacked up about this. Okay, we got the new private stock group, private wealth group cards. I don't know how well you guys can see those here. They're steel. I'm excited. So every new member will get one of these sent to them. So it's just a small thing. I'm excited, but this is always the creme de la creme, baby. You got the 6-figure club award when you hit 6 figures in your portfolio, the diamond award. That's a heavy beast. And then you got big dog. When you hit $1 million plus in your portfolio, we send you one of these guys. I think we've sent a little over 100 of those all time. These guys, we probably sent maybe 500 of these or so over the years. So anyways, if you're looking to apply to join my private stock group, the private wealth group, that will be in the description area. It might also be a pinned comment down there. Let's get into this.
To have you back. I think most people
great to see everybody.
Yeah, I think most people know you as one of the more positive voices about the market from the get-go, really. And I think my first question to you is, how could you possibly still be as positive as you were 2 weeks ago today?
Scott, we can't. We sent a note out to our clients on Sunday evening just noting there are going to be ripple effects from the SIVB failure because the cost of money for banks is going up, so it's going to drive a necessary contraction in credit. And it's pretty clear to us, especially talking to some founders, that not only are many nervous where they bank, but some regulators have actually been advising banks to pull back their sort of lending to fintech startups. So I think you're going to see job losses start. So I think that this is all as Steve put it.
Tom Lee, in all due respect, job losses start. Did you not see 2022? Tom Lee, did you miss 2022? Tom Lee, were you asleep? What happened? What happened here? Okay, I don't know if anybody was keeping track, but tech layoffs were substantial in 2022. That was the year of tech layoffs. I mean, everybody, Tesla, Meta, Amazon, huge cuts. I mean, it was company after company after company after company. Everybody and their grandma in the tech field did layoffs last year. So I don't know if Tom Lee missed that one. But yeah, last year was the big. We're still going to get some tech layoffs this year, right? You got Meta doing a second layoff here. You'll get a few more companies. Maybe Apple does a little layoff later in this year if they miss numbers and have an excuse to do a layoff there. Something like that, right? Could maybe see a little bigger Google move. But nonetheless, folks, last year was really the big year for layoffs in the tech field. So I don't know where Tom Lee was at. That was a worse year for tech layoffs, maybe ever, but certainly since probably the great financial crisis.
Big deflationary impulse coming, and it's almost now raising stakes in terms of what the Fed does. So I think it's tough, Scott, to be bullish here, but it doesn't mean that we've broken the economy.
Well, yet. But
yeah,
I understand. Look, there's a difference between the tough.
Look at this guy. This is a Short Hills Capital guy. But from my understanding, I think that fella, I think he switched to the bullish side a few weeks ago, and he's always like negative. But I think it was Mav or somebody said that he switched sides recently. Maybe it was myself. Maybe I'm the one that said that. Maybe I've reacted to a video here on the channel. Sometimes I do so many videos, sometimes I forget which ones I do. But I swear, didn't I react to a video where he switched sides? Or somebody said he switched, but I was like, wow.
your word of being bullish and just flat out wrong. Is it wrong to be bullish today, Tom?
I think it's wrong to be bullish short term, because it's not like anyone can step in today and say, oh, the market's down 2%. I want to buy equities. Now, we haven't been overweight financials. As you know, our top pick this year has been technology, and that's actually holding up great. But the reason I think someone could say you haven't broken the market long term is, number one, the biggest risk to the market has been inflation. I mean, that's been a problem for...
Of course, you never break the market long term until you break the United States of America and all the other dominant countries economically. Once you do that, then you could break the market long term. What are we talking about here?
Number one, banks, because their mortgage holdings and their securities holdings have been hurt by higher rates. And it's also because it's, higher rates and inflation risk have pressured PE. I mean, if we've broken inflation, which is pretty apparent looking at Fed fund futures and the inflation break-evens and even yields, that's actually helping to re-liquefy banks. So it's taking out some of the risk there. But it's also helping PE. The S&P today is at 14 times next year's earnings ex-FANG. So if you look at sort of the median stock, the market has derated huge. I mean, you're getting over a 7% earnings yield today owning equities.
Yeah, so I don't really agree with his whole, let's take out FANG and let's, run market valuations in that sort of a thought process. I mean, I'm just not agreeing with that. You got to throw those babies in there as well. One important factor, I think, that I need to say right now, okay, is the fact is nothing has changed over the past week. You had SVB go under, but you could say, no matter what, there's going to be some financial institutions that weren't going to make it in this whole mess, right? When the Fed raises rates that quickly, you're going to have some sort of damage out there in regards to those. There's a reason I don't own any of those financials. There's one financial-related stock I own, right? One bank, JP Morgan, in my dividend-only account. That's it. The reason I don't own those, I think anybody who was going into this year and thinking like there wouldn't be any type of problems there is just sorely mistaken, right? And that's why I stayed away from those last year, stayed away from those this year, and actually I stay away from those pretty much every single year other than JP Morgan. That's the only one that interests me. Goldman Sachs used to be interesting, but they've gotten a little away from their game over the past number of years. If I see them get back on the right track, maybe Goldman Sachs is something I can consider in future years. But outside of that, no, okay? And so all these people are shocked by what's going on, and I'm just like, the writing's kind of been on the wall when it comes to some of those financial institutions. They've been doing some dangerous stuff, man. They've been doing some dangerous stuff. They've been pushing limits, and especially for a lot of those smaller guys, they can get away with a lot more because the regulators aren't on a lot of those smaller dogs. The JP Morgans, the Bank of America's, Wells Fargo's, all those big dogs, I mean, the regulators are all over them constantly. But for a lot of those smaller banks, when you get down to the 15th, 20th, 35th biggest bank, I mean, I'm just telling you, the watchdogs are not on those like they are on the big dogs, okay? The top 5, let's call them that, okay? Next video up here, BTIG is now predicting we're going to go under October lows. Interesting. Let's hear it, which for S&P 500, that would be down another 175 to 200 points roughly from here.
Look, there's a lot of moving parts. Things are moving very quickly, obviously, but big picture, we're kind of targeting the December lows near term, which are on 37.75 in the S&P 500. But ultimately, we continue to expect those October lows to break. And I think one thing to know: last week on Sunday was the 5-month anniversary of the October bottom, and so we looked back throughout history and looked at all new bull markets and how they perform 5 months later. The average return off of the bottom 5 months later is about 31% back to 1928. We're only up 8%, which, if that October low was the final low, would make it the third weakest bull market start in history. So we think it's
completely irrelevant. All these bulls and bears, they pull out, and Tom Lee's famous for this, pulling out these random stats. Completely irrelevant. It doesn't matter a flip and flapjacking thing, okay? At the end of the day, the market we're in right now, what's going on today is very different than whatever happened in the last scenario, There's not one scenario in history, and I know all the way back for the last 150 years when it comes to the economy. There's not one time period in the past 150 years or ever in history you can look back to that is similar to what we're going through right now. Not one. Not one. You can say, well, inflation was high in the 1970s. This is not the 1970s, okay? There's a lot different right now than there was back then. You say, well, the great financial crisis, this ain't the great financial crisis, okay? That was a whole different batch of worms there and a whole different setup and a whole different everything, okay? And so I think when you really start to dive into this stuff the way somebody like myself has time to do this, because I had nothing better to do all day than look into the economy, look into companies, listen to earnings, look back at past time periods and that stuff. Once you really start diving into the weeds of this stuff, you start realizing this is a whole different ball game. What we're going through, we got different dynamics, we got different companies, we got different things going on than what happened in this previous time period. And so when they bring up these stats about, well, the average was this, it's meaningless, folks. It's completely meaningless. It doesn't mean anything, okay? Bullish or bearish. And like I said, Tom Lee, the guy we just watched, who always is bullish and now all of a sudden he's flipping to the bearish side, right? He's famous for bringing out these random stats and statistics. And if you watch my channel all the time, you know I laugh at him because it's just he's always got some random stat to bring up, and it's like, come on, man.
But while it's possible, it's more likely that those do get broken, especially when we look at all the different cross asset classes that we continue to monitor and look at a weight of the evidence approach.
If people agree with you and think we are going to go back to the October lows, what leads us down? What sector would you be fading more than any other right now?
It's interesting. There's been a massive reversal in the value to growth trade as the narrative has quickly switched from inflation concerns to economic concerns. And I think that's pretty typical. As you get into bear markets, you get a reversion as the long end of the yield curve moves down, anticipating slower economic growth. You get some underperformance in the value areas, and you get some relative outperformance in growth. So that makes sense. I think for here and now, in the near term, I think the rotation into growth is probably.
You know what I'm trying to figure out? I was just kind of thinking about this. I was just thinking, like, why is Wall Street so depressed? Like, holy smokes, man. These people are in depression. I'm like, oh, my God. I'm like, what is going on here? You know what I was thinking? A lot of these folks, what were they talking about positioning? They were talking about positioning in the financials and the banks. If you watch CNBC, Bloomberg, whatever, for the past 6, 9, 12 months, okay, these folks have all been talking about you need to position in financials, you need to position in oil, gas stocks, those sorts of things, right? And also playing commodities. And look what's going on. Commodities is approaching the lowest readings we've had in quite some time, like, well over a year, if not longer than that, okay? And approaching back to normalish ranges. If you look at the commodity ETF in general, we're approaching ranges we were last at back in 2018, 2019, which is, thank goodness, we're getting back to those ranges, okay? So if you're in commodities, you're pretty much getting screwed. We know oil and gas stocks are getting wrecked recently, right? Including today, a lot of those oil and gas stocks are down 6, 7, 8% in a day, right? And then you look at the regional banking index, it's down nearly 30% in the past month. And so being that Wall Street's likely positioned in a lot of those stocks, I understand why they're in a state of depression because I'm just watching them and I'm just like, holy smokes, man. Anybody think their dog died? I'm like, oh my gosh, like what is going on here with these folks? These people are like, maybe they're all afraid the banking system's going down, so they're all going to lose their jobs in the finance field or something. I'm like, oh my gosh.
So we've been highlighting semis. They're still up 17, 18% on the year. They seem like a good fade to us here. But then you look structurally and, you've had some pretty ugly reversals in areas like materials and industrials, which, just a few weeks ago were showing multi-year relative highs, and they've quickly given that back. So it just goes to show in bear markets, things move fast. You got to stay on your toes. But we don't think that anything really survives in absolute terms. It's really just a relative game.
Does this breakout in gold have more legs, and if so, how much?
Yeah, gold.
I don't know what all this bear market talk is because, damn it, this year I feel like we're in a bull market, baby. That's all I got to say. Last year was worse than a bear market. This year, to me, I feel like we're in bull market, baby. I'm loving this year. Ooh.
A frustrating trade. It tends to trade very strongly inversely to the U.S. dollar, but today look at gold up with the dollar up as well. So it's acting really like a risk-off asset. And you look at the kind of the structural picture for gold. We basically had 3 years of basing, And now you have the other thing gold trades very strongly with are real rates. So real rates are starting to fall. That should benefit gold. We think it gets that 2,000 level. If it takes out 2,000, you're talking about a pretty nice multi-year breakout. So I do think gold is worth holding here.
Man, bear market. S-Dow calls are printing money. Meta's printing money. Tesla's been printing money this year. Elf's been printing money this year. I don't know what all this bear market talk is. I'm just like, I'm confused. I definitely felt it last year, but damn it, I haven't felt it since probably November. It's been pretty good around here. That's all I got to say about that. Next one up here, next shocking one. Piper Sandler is calling for a hard landing, which is just a fancy way of saying major recession.
To see the impact across the economy. Piper Sandler chief strategist Michael Kantrowitz, he's gotten it right on our air for the past year, telling investors in January to buckle up for a long recession, saying stocks won't bottom until PMIs do, and it could be a long 2-year road ahead. Today, he says we have all 3 ingredients in place for a hard landing. Mike, it's good to see you again. Welcome.
You too. Hi, Kelly. Hi, Tyler.
About the only thing I think I can fault you for is being early at this point, because we all thought perhaps by now the labor market and jobless claims would be cracking. What's really interesting is to see the way that we're starting to see credit markets seize up even without that happening. So what's your take?
Yeah, I mean, we've seen, as you mentioned, we have, we've got a lot of problems that are starting to pop up. We've got knowns and unknowns, and I think there's a lot more. And those 3 ingredients that you mentioned, I'll reiterate, which is the Fed raising interest rates, commercial banks tightening lending standards, and an inflation problem. All of we've had these 3 issues for about a year now. It takes time for that to flow all the way through into earnings and the labor market. But obviously, the early signs of that it's having an impact, whether it's through the markets last year and tech stocks getting hit, housing fundamentals in the economy getting hit, and now it's flowing into banks. So it's the rate sensitivity flowing from the earliest parts of the economy and financial markets that are susceptible to it. And the end game is ultimately the employment backdrop. And that's for us when
these Wall Streeters are hurting, man. You can tell it. But you know what I got to say, folks? I wouldn't be surprised if the average American actually feels far better in 2023 than they did in 2022. I wouldn't be surprised at all. I'm talking about the average American, right? Is some people going to feel worse? Sure. But I think the average person is going to feel far better in 23 than 22. Inflation breaking the way it's starting to break now at this point in time. If you look at consumer confidence, for instance, that tells you essentially how the average person's feeling out there. And we saw the lowest readings in the history of that. That goes all the way back to the 1950s. That survey's been done. So it was done in the 70s when they had super high inflation. It was done in the Great Financial Crisis. It was done in Rona. It was done in all these different time periods. And it was done, obviously, in the tech bubble. It was done at all those times, right? It was done in September of 2001, which was a pretty significant time period, right? And never have we ever seen consumer confidence as low as it hit in 2022. And what we're starting to see is basically since the summer of 2022, consumer confidence has started to improve, and it's actually continuing to improve. And I wouldn't be surprised if as 2023 rolls along, consumer confidence gets better and better and better. While the Wall Streeters are hurting, I wouldn't be surprised if the average person is feeling a lot better, to be quite frank. Last year, a lot of these Wall Streeters didn't really feel the pain. They were doing just fine, right? And the average person was out there telling us in surveys that they were feeling the least optimistic about the economy, about how everything was going, that they had been feeling basically ever, which is quite telling, right? And so we have a divergence between, kind of what's going on out there and the way certain people are feeling and, the way an average person's feeling now versus what they were feeling, when obviously we're hitting some of those CPI 9% in those sorts of numbers, right? Now time's at least catching up where wages can start, catching up here.
Starts and looking at the forward-looking indicators of employment, that seems to be something that begins in the middle of this year and becomes the dominant risk for equity markets.
Right. And, I'm sure you saw this, but Bank of America, they put out a note last night, Subrita, saying we're now in late cycle in the downturn phase. Torsten Slok at Apollo this morning saying he's gone from thinking we're going to have no landing to thinking we're going to have a hard landing. So
good. Good. Bearish, 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 bearish. Overwhelm the bearishness. Good.
A lot of strategists are kind of catching up with your view and with the warnings you've been putting out there for quite some time. Tactically, for equity investors, What do they do? I mean, we heard earlier last hour about those who believe a recession's coming and are still positioned for the rebound already. You know, the asset classes that are in sectors that are usually outperforming coming out of that event. Is that something you think investors can be trying to do right now?
Well, you know, it's our job on the sell side as a macro, especially in the macro world, to talk about big picture stories that are coming up. And so, you know, the irony, and it's something I often tell clients, is, you know, I'm not a big believer that the markets are very forward-looking, and I think that's been on full display over the last 12 months, and increasingly, you know, over the last 12 days, if not 12 hours. And so, if you're betting on a recession that's going to happen in 6 months and positioned for that, you know, six months too early, yeah, you're going to be wrong. And historically, bear markets really end up in a recession when unemployment claims start to rise. And, you know, ironically, it's also a bit of a problem today because employment is a bit too strong. So, you know, I think we're looking at, you know, we have a framework. We've tried to be remarkably consistent with our views despite the market volatility, which again is commonplace for bear markets. And the catch up that is being made now by other analysts, I think is occurring as we see the lagged effects of this tightening cycle play out, and there's a lot more to come. And so our recommendation to investors at the start of the year, though we have a bearish outlook for year end when employment breaks, is that you want to remain actually somewhat balanced in really high quality companies. And because we believe the market's going to be bouncing back and forth between soft landing hopes and recession fears. And like you just said, Kelly, in the last 6 weeks, we've gone from euphoria. The S&P high beta index was almost at an all-time high to today, you know, in a panic mode.
Yeah, it happens quick in regards to markets, right? And like I've been preaching, obviously, on the main channel, you know, different years represent different opportunities, right? Last year was really the growth stocks were the crazy opportunity, right? 2023, the growth stocks do not represent that type of opportunity. They still are an opportunity. Let's be clear about that. But they're not the opportunity they were last year. These stocks are all at very, very different prices now at this point in time, okay? The opportunity this year is in value stocks and dividend stocks. Those are the ones that are really being hit. Those ones held up actually in the first half of 2022 actually pretty darn well. But I'm telling you, for the remainder of this year, it's all about value stocks and dividend stocks. That's where the true opportunities are in this market. And those are actually where I'm mostly focused for, you know, let's call it the next 6 to 9 months. Growth stocks, I'll still buy a few here and there, but I'm just telling you, like, a lot of those have come back 50%, 100%, 150%. And, you know, there's different opportunities in different markets. And right now, man, there's a lot of great dividend stocks that have yields 4, 5, 6% and are great companies that aren't going anywhere and are going to keep cash flowing regardless of the economy. So I appreciate everybody joining me. As always, 24,600 plus subscribers now on this channel. If you're looking to apply to join my private stock group, the private wealth group, and start scaling up your wealth, check out the pinned comment down there to apply to join us in there, and have a great day.